This is problem 7.8 from Brigham and Houston, Fundamentals of Financial Management, Concise 9th edition. This is a problem that's measuring what actually happened to an investor, and we're measuring the impact of a call on the investor. So 7 years ago, Templeton Company issued 20-year bonds. So 7 years ago, they issued them at 20 years. Today, they're 13-year bonds. They had 11% annual coupon rate at their $1,000 par value, so they're paying $110 a year in interest. Got a 7.5% call premium with 5 years of call protection. That means that the bonds could not be called within the first 5 years, and when they could be called, the Templeton would actually have to pay $1,075 in par value rather than just $1,000. Okay, and then today Templeton called the bonds. They had 13 years to go, but they called them early. All right, here's the rule of thumb. There is never a time when a corporation will call a bond unless it screws the investor. That's the only reason to call the bond. They're going to have to pay $1,075 for the bonds. The only reason that you would pay $1,075 is if the bond was worth more than $1,075. So let's look at this and walk through the process. When they first issued the bonds had 20 years to go. We'll solve for the rate. They sold them at their par value of $1,000. So they sold the bonds at $1,000, and that's also the par value. And the coupon payment is 11% of par. That's $110. The only time the price of a bond is exactly equal to the par value, the only time that happens is when the yield to maturity is exactly equal to the coupon rate. All right, and bonds are typically issued with a coupon rate set near their yield to maturity because companies tend to try and price these things so they could sell them at par value, all right, when they're first issued. Once they start trading back and forth between investors, and over time the price goes up and down and all around. Let's solve for the rate here. And that would have been 20 periods, payment of $110. An investor would pay $1,000 for that, $110 a year, and then receive $1,000 at the end of 20 years. So that would have been the rate of return that they were earning. Now, today Templeton called the bonds after they had made 7 payments. So what we want to look at is the realized rate of return for an investor. An investor who invested and bought one of these when it was first issued thought they would earn 11% by getting $110 a year for 20 years and then getting their $1,000 back. Okay, well, let's set up a timeline here. 1, 2, 3, 4, 5, 6, 7. All right, so they called the bonds after they had been outstanding for 7 years. And so this is the cash flows from the investor. The investor took $1,000 out of their pocket at day one and then got $110 a year for each of 7 years. And then in the 7th year, at the end of the 7th year, they also got the return of principal and the call premium. Now when it says the call premium is 7.5%, it means they give par value plus 7.5%. So they got their last coupon and they got their $1,075 back. So if I'm going to solve for an IRR here, that'll give me the rate of return. And it turns out that the investor made 11.75% on their money. Wow, happy investor, right? Well, remember what I said, the only time that a company's going to call bonds is when it screws the investor. So did they just do it wrong? When the bonds were issued, the interest rate was 11%. Because the bonds have been called, the assumption is that interest rates have come down. Let's look at a non-callable bond, all right, a comparable non-callable bond. Now, after 7 years, the bond would have 13 years to go. And let's say market interest rates had dropped to, 8%. What would a non-callable bond that's going to pay $110 a year for 13 more years and then give you back your $1,000, which would be all the period remaining on the Templeton bond. When you bought it, you expected 20 years of payments. It's 7 years later, you're not going to get any more payments. So you'd take that extra money that you got here and you go buy another bond that'll also go 13 more years. Except that the price on that bond is going to be more than $1,075. If we solve for a comparable bond that had 8%, which is now the market interest rate, 13 more years, it's paying $110 a year, and then $1,000. When you take your $1,075 call premium, the par and call premium, and go to buy a replacement bond, you can't buy one for $1,075. So what we can see is if this investor, instead of buying a callable bond, had bought a non-callable bond, all of this would have been the same, except that he could have sold it at the end of year 7, but not for $1,075. Could have sold it for $1,237, which would have meant that he would earn a higher rate of return still. So is the investor happy? Well, $11.75 is better than 0, but it's not as good as it could have been. The only time a corporation calls its bonds is when it hurts the investor. Otherwise, they're not going to do it. If interest rates had gone up from 11%, let's say they went up to 13%, the company isn't going to call bonds and pay $1,075 for them when they're selling in the open market for $878. The only time that the company is going to call those bonds is when interest rates go down. All right, if interest rates go down, price of the bonds going up, except that there's a limit on how much it can go up because the corporation has the option of buying it back for $1,075.